Preparing for a financial analyst at Dish interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a financial analyst do, and how would that role support Dish? A financial analyst turns operating data into decisions. At Dish, I would support budgeting, forecasting, variance analysis, management reporting, and investment evaluation across wireless, pay TV, and corporate functions. I would connect subscriber trends, ARPU, churn, network spending, content costs, and liquidity to financial outcomes. The strongest analysts are accurate, commercially curious, and concise with senior stakeholders. My goal would be explaining what changed, why it changed, and what management should do next. While answering, focus on budgeting, forecasting, performance analysis, management reporting, decision support, cross-functional communication, and how analysis can improve subscriber economics, liquidity, network investment, and operating discipline. Question 2. How do the three financial statements connect? The income statement measures profitability, the balance sheet shows resources and obligations, and the cash flow statement explains changes in cash. Net income flows into retained earnings and starts operating cash flow, while depreciation is added back and working capital movements adjust cash. Capital expenditures reduce cash and increase property, plant, and equipment. Debt financing increases both cash and liabilities. I always reconcile ending cash and investigate inconsistencies before presenting results. Make sure to cover net income flowing into retained earnings and operating cash flow, non-cash adjustments, working capital, capital expenditures, financing activity, and the balance sheet linkages relevant to a capital-intensive telecom business. Question 3. How would you analyze DISH's revenue model? I would disaggregate revenue into subscriber volume, pricing, product mix, and non-recurring items. For wireless, average subscribers multiplied by ARPU provides a useful operating bridge, while device sales, activation fees, and promotions require separate analysis. For pay TV, I would examine customers, package mix, and service pricing. I would then compare reported growth with underlying growth, separating sustainable customer economics from promotional activity or one-time equipment revenue. In your answer, talk about subscriber additions, disconnects, average subscribers, ARPU, equipment revenue, advertising or other revenue, revenue recognition, product mix, and the distinction between growth quality and headline growth. Question 4. Which KPIs would you monitor for DISH's wireless business? I would monitor gross adds, churn, net adds, ending subscribers, ARPU, customer acquisition cost, retention, device costs, and service revenue. I would also track network utilization, coverage progress, data usage, and capital spending because a growing base is valuable only if service quality and unit economics remain healthy. I would build a KPI bridge from subscribers and ARPU to revenue, then connect acquisition, network, and support costs to EBITDA and cash generation. Be sure to mention net additions, gross additions, churn, ARPU, customer acquisition cost, retention, network utilization, data usage, device financing, EBITDA contribution, and how operational metrics translate into cash flow. Question 5. How would you explain the relationship between ARPU and churn? ARPU measures average revenue per subscriber, while churn measures the rate at which customers leave. Raising prices may increase ARPU but hurt retention, especially in price-sensitive segments. I would analyze both metrics by cohort, plan, geography, and tenure, then estimate customer lifetime value using contribution margin and expected retention. A healthy strategy maximizes long-term value, not simply monthly revenue, so I would test whether pricing changes improve economics after incremental churn. While answering, focus on average revenue per user, customer price sensitivity, promotional discounts, service quality, cohort behavior, retention economics, and why maximizing ARPU alone can damage lifetime value if churn rises materially. Question 6. How would you build a monthly financial forecast for Dish? I would begin with historical actuals and identify the operational drivers behind each major line item. Subscriber forecasts would feed service revenue, ARPU assumptions, churn, and acquisition costs. Separate schedules would cover network investment, headcount, content, equipment, and working capital. I would document assumptions, incorporate seasonality, and create base, upside, and downside cases. After each close, I would compare actuals with forecast, explain variances, and recalibrate assumptions. Make sure to cover historical baselines, operational drivers, assumptions, seasonality, revenue and expense schedules, headcount, capital expenditures, working capital, scenario cases, ownership, and forecast versus actual feedback loops. Question 7. How would you investigate a material EBITDA variance? I would first confirm the variance is real by reconciling the ledger, reporting definitions, and period cutoffs. Then I would decompose it into volume, price, mix, timing, and cost drivers, comparing actual results with both budget and prior year. I would speak with the accountable business owners, validate supporting data, and distinguish recurring from one-time effects. Finally, I would quantify the full-year impact and recommend a forecast or control adjustment. In your answer, talk about isolating price, volume, mix, timing, foreign or unusual items, cost categories, accruals, operational ownership, materiality, root cause validation, and corrective actions for the next forecast. Question 8. How would you structure a financial model for a telecom company like Dish? I would separate the model into assumptions, operating schedules, financial statements, cash flow, valuation, and outputs. Subscriber cohorts would drive connections, churn, ARPU, and service revenue. Separate schedules would model devices, network capex, depreciation, operating costs, working capital, and financing. I would include monthly detail where liquidity matters, annual summaries for presentation, and checks for balance sheet balance, cash roll forward, and subscriber reconciliation. Every key assumption should be visible and documented. Be sure to mention clear inputs, operating drivers, revenue build, subscriber cohorts, expense schedules, capex, depreciation, working capital, debt, cash flow, checks, scenario controls, and transparent separation between assumptions and calculations. Question 9. How do capital expenditures affect DISH's financial analysis? Capital expenditures reduce near-term cash flow but create assets that support future service revenue and capacity. I would distinguish growth capex, such as network expansion, from maintenance spending, then model timing, capitalization, depreciation, and expected utilization. I would evaluate projects using incremental revenue, operating savings, payback, and return on invested capital rather than viewing all capex equally. For Dish, the liquidity profile makes timing and funding assumptions especially important. Focus on network build-out, spectrum-related investment, cash flow timing, property and equipment, depreciation, capitalization policy, return on invested capital, utilization, maintenance versus growth capex, and liquidity implications. Question 10. What is spectrum, and why is it important to DISH's financial performance? Spectrum is licensed radio frequency capacity used to deliver wireless service. It can improve coverage, speed, and network capacity, but licenses require substantial investment and may include build-out obligations. I would analyze acquisition cost, timing, financing, amortization, deployment spending, and expected subscriber or wholesale economics. The strategic value depends on how effectively spectrum is converted into network performance and revenue, so I would connect technical milestones to financial returns. In your answer, cover spectrum as a finite wireless resource, coverage and capacity, licenses, auction costs, build-out obligations, amortization, network economics, competitive positioning, and the trade-off between strategic value and financial burden. Question 11. How would you assess DISH's free cash flow? I would start with cash flow from operations, then subtract capital expenditures to calculate a practical free cash flow measure. I would separately identify interest, taxes, spectrum payments, restructuring costs, and other unusual cash items because reported cash flow may not reflect recurring economics. I would also analyze working capital movements and payment timing. The conclusion should address both current cash generation and whether projected liquidity is sufficient to fund network investment and obligations. Make sure to cover operating cash flow, capital expenditures, working capital, interest, taxes, spectrum payments, restructuring or transaction items, recurring versus non-recurring cash flows, and the effect on liquidity and financing needs. Question 12. How would you evaluate a company's liquidity and debt position? I would build a cash bridge showing beginning cash, operating cash flow, CapEx, spectrum or acquisition payments, financing activity, and ending liquidity. Then I would map debt maturities, coupons, covenants, collateral, restricted cash, and available facilities. I would stress test subscriber losses, slower revenue growth, higher rates, and delayed funding. The key question is not simply leverage, it is whether the company can meet obligations while continuing strategically necessary investment. While answering, focus on cash balances, unrestricted versus restricted liquidity, maturities, interest expense, covenants, refinancing risk, operating cash flow, cash burn, revolver capacity, and downside scenarios rather than relying on leverage alone. Question 13. Which valuation methods would you use to analyze DISH? I would use a DCF as the primary intrinsic framework, supported by trading comparables and relevant transaction benchmarks. For a telecom company, I would compare enterprise value to EBITDA, revenue, subscribers, and potentially network or spectrum metrics, while carefully adjusting for leverage and business mix. The DCF would incorporate subscriber trends, ARPU, margins, CapEx, working capital, terminal assumptions, and net debt. I would present a valuation range, not false precision. Be sure to mention discounted cash flow, trading comparables, precedent transactions, enterprise value, equity value, subscriber and revenue metrics, net debt, spectrum assets, scenario analysis, and the limitations of each method. Question 14. How would you perform a sensitivity analysis on a DISH forecast? I would first identify the assumptions that drive value most materially, such as churn, subscriber growth, ARPU, EBITDA margin, CapEx, discount rate, and terminal growth. I would vary one assumption at a time for diagnostic sensitivity, then use combined operating cases for realistic outcomes. A two-way table or tornado chart would show decision-makers the range of results. I would explain which risks are controllable, which are external, and what monitoring indicators matter. In your answer, discuss identifying the assumptions with greatest valuation impact, varying churn, ARPU, subscriber growth, margins, CapEx, discount rates, terminal growth, presenting tables or tornado charts, and interpreting decision implications. Question 15. What would you include in a downside case for DISH? My downside case would combine slower gross additions, higher churn, lower ARPU, heavier promotions, delayed network milestones, and elevated customer acquisition costs. I would also stress higher CapEx, inflation, interest expense, and refinancing constraints, then model the effects on EBITDA, free cash flow, and liquidity runway. Importantly, I would not stop at the output. I would identify management responses, such as reducing discretionary spend or revising rollout timing, and quantify their benefits. Make sure to cover weaker subscriber additions, higher churn, pricing pressure, promotional intensity, delayed network deployment, elevated CapEx, higher financing costs, covenant pressure, liquidity runway, and management actions that could mitigate downside. Question 16. How would you decide whether DISH should pursue a proposed network investment? I would evaluate the investment on an incremental basis. First, I would clarify the strategic objective, then estimate additional subscribers, ARPU, avoided costs, network operating expense, CapEx timing, and useful life. I would calculate NPV, IRR, payback, and cash flow impact under multiple utilization and adoption scenarios. I would also compare alternatives, including leasing or delaying deployment. A positive return is not enough if the project creates unacceptable liquidity pressure or execution risk. Focus on strategic rationale, incremental subscribers and revenue, avoided costs, CapEx, operating expenses, timing, risk-adjusted returns, payback, NPV, IRR, utilization, alternatives, and alignment with liquidity constraints. Question 17. Tell me about an accounting judgment that could affect financial analysis. A judgment such as capitalizing versus expensing certain implementation or network costs can materially affect EBITDA, assets, and future depreciation without changing immediate cash outflow. I would understand the accounting policy, identify the judgmental inputs, review precedent and documentation, and involve controllership or auditors where appropriate. In analysis, I would separate accounting presentation from underlying economics, disclose the impact clearly, and maintain consistent treatment across periods and scenarios. In your answer, mention revenue recognition, capitalization versus expense, impairment, useful lives, reserves, estimates, materiality, audit support, consistency, and how accounting judgments affect comparability, EBITDA, cash flow, and forecasting. Question 18. Which Excel tools and analytical techniques do you use most often? I use SumIfs, XLOOKUP, index match, pivot tables, charts, and structured tables regularly. For larger recurring datasets, I use Power Query when available, but I keep the final model transparent and easy to audit. I build checks for balance sheet balance, cash roll forward, missing inputs, and unexpected movements. I also use scenario toggles and sensitivity tables. The objective is not sophisticated formulas, it is producing reliable analysis that others can review quickly. Be sure to mention XLOOKUP or index match, SumIfs, pivots, data validation, error checks, charts, scenario controls, Power Query when appropriate, auditability, version control, and communicating outputs rather than showcasing formulas. Question 19. Describe a time you found an error in a financial analysis. In one analysis, a monthly expense variance appeared unusually favorable. I reconciled the report to the general ledger and found that an accrual reversal had been included in the current month while the related expense belonged to the prior period. I confirmed the issue with accounting, corrected the variance bridge, and explained the recurring run rate impact to management. I then added a period cutoff check to the process. The lesson was to validate timing before interpreting performance. While answering, focus on the investigation process, data reconciliation, root cause, communication style, correction, control improvement, ownership, and the lesson learned without blaming another team or overstating the mistake. Question 20. Why do you want to work as a financial analyst at Dish? Dish interests me because it combines subscription economics, network investment, spectrum strategy, and meaningful liquidity decisions. That creates a strong environment for an analyst to connect operational KPIs with financial outcomes rather than analyzing isolated numbers. I would bring disciplined modeling, attention to detail, and a willingness to understand the business behind the data. I am especially motivated by roles where forecasts influence capital allocation, performance management, and practical operating decisions. In your answer, connect interest in telecom economics, network investment, subscriber analytics, a changing competitive environment, hands-on forecasting, cross-functional exposure, analytical rigor, and how your skills can contribute to DISH's decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.